You'll be moving the slides? Okay. All right. So we've discussed quite a few concepts this morning, and I commend all of you that are still hanging in. So, and for those who will be watching this through the video, welcome. So this segment is really talking about how do doctors protect themselves from this new tax on passive income that was brought in by the federal government in 2018. And the big problem with this tax on passive income is that what it does is that it penalizes those of us who are using their corporation to save for retirement and to accumulate passive income. So it's not a deemed disposition like the ones that happens every 21 years in a trust, or when you become a non-resident, or when you die, but it is an immediate increase in your taxation while you're alive and while you're earning income. Now, let's start with the very beginning. Classic tax planning that we've seen over the years is that the medical corporation is set up to take in the income from the provincial health insurer like OHIP in Ontario. And the reason why that is because we want to only pay the lowest possible active business income tax on that income that's coming into the corporation. Right now in Ontario, and it's different across other provinces, on the first $500,000 of active business income, the company is exposed to a 12.2% tax rate. So if round numbers, if there's $1 million of OHIP income coming in, only 12.2% of that is taxed as active business income. The next rung of the classic strategy is to take those retained earnings, so anything that hasn't been taxed that's staying in the company, and investing it either in stocks or in real estate. The goal there is to buy instruments that don't immediately create tax. So if you buy a stock and you hang on to that stock, there's no capital gain because you haven't sold it. So the stock increases in value inside the investment account of the corporation, and you're not exposed to ongoing taxation. Real estate, same thing. If you don't have a tenant paying you rents, if all you're doing is buying and holding to some real estate, you have your adjusted cost base, as Nick and Simon told us about. And then until such time as the property is sold and the capital gain is realized, there is no tax. And then the last rung of this classic strategy is, so do this, pay as little tax up front, try to not pay any tax while it's invested in the company. And then when you need money, just declare a dividend. Because obviously you don't have a pension plan. So you're going to declare a dividend and repatriate some of these corporate dollars back into your pockets. Now, I'm not talking about the insurance strategies that Andrea and Nick and others mentioned. I'm just saying this is the classic, simple advice that a lot of physicians have been getting from their accountants. So that's that. Now we move to the next slide. The problem is that this strategy causes all kinds of problems. So we've got three here. One is that if these retained earnings that are invested inside the corporation are generating income, because it's one thing to buy stocks and hang on to them for 30 years, but unless you're Warren Buffett, and even he would do that, it's very difficult to make a call on a stock and hang on to it and never sell it. You have to trim, you have to rebalance, you have to see what's going on with corporations, with industries, which means at some point you'll have to sell those stocks. And that means you're going to be exposed to tax along the way. but it won't be active business income tax at 12.2%. It's going to be taxed at a much higher rate. Now, at the top end, the worst type of income that a corporation that's investing passively can face is tax on foreign dividends and interest income. Because the corporation is looking at a 50.17% tax rate on any of those, on that income earned. Remember, after you pay the 50%, you have to declare a dividend to get into your pockets. So you're going to be facing personal taxation as well. So now we're beyond a 50% tax rate for this income that was earned in foreign dividends or interest income. So it's a way of destroying wealth if it's not managed carefully. The second issue is that, as Nick and Simon spent some time explaining to us, if you don't sell the shares, but there's death, then we have the deemed disposition problem. So the taxman doesn't disappear just because we're using shares. And then the other big problem, and this is what this presentation is all about, is that now there's a third problem that the government has thrown at us. And it's the fact that if we have too much passive income growing inside of a corporation, now after we've reached a certain threshold that's okay, that's safe, we're going to be suffering a passive income grind or PIG on top of everything else. So let's look to the next slide and we'll get to those definitions. So just a quick recap on why we have the tax on passive income. Back in 2017, the federal government published a white paper on the taxation of Canadian-controlled private corporations, which is what these medical corporations are. I'm a medical professional corporation. And in that white paper, I read it. They really came at the physicians and the doctors and lawyers and others that are incorporated, and virtually, they didn't say it, but it almost said that you guys are all tax cheats. That was the message from that white paper. And so they came up with a whole bunch of new measures, which, if those had been adopted, would have caused tremendous harm. Luckily, the business community fought back and lobbied. And out of the 5 measures that were proposed in this white paper, 3 were dropped and 2 were kept. One is the tax on split income and the other is the tax on passive income. So we're stuck with those 2. So in 2018, the legislation was passed and started to take effect in 2019. Start to bite in 2019. So what do these rules do? Well, these new TOPI rules introduce a mechanism whereby when you have passive income earned in your company, but not just the medical corporation, it also extends to what are called associated companies, other companies that are tied together. If there's passive income happening there, it still is caught by these rules. And so if you have too much income, then what happens is the $500,000 active business income allowance. This is the ability of the corporation to only pay tax at 12.2% in Ontario. It's lower or higher depending on your province. The ability to benefit from that low tax rate disappears because of the pension income grind. So next slide. So it's best to use an example. So if my medical professional corporation, let's say I have other associate companies like a real estate holdco or some other company, collectively earn $50,000 of passive income in a year, I'm fine. I'm under the new measures. I'm under the radar and nothing happens. But as soon as we hit this 50,000 threshold, for every extra dollar that's earned in this way, in a passive manner, we lose $5 of that $500,000 small business allowance. So put another way, If the total passive income exceeds $150,000, if we take away the 50 that's safe, we have $100,000 of passive income. Multiply by 5, that means our entire $500,000 small business allowance of active business income can no longer rely on the 12.2% rate. On the first dollar, we must pay 26.5% tax on active business income. Next slide. So that means that since now I have to pay tax at 26.5 on that first 500,000, I have to pay an extra 71,500 in taxes, just because I had too much passive income in my company or in my associate companies. It's like a brand new tax that's been levied to penalize me because I didn't want to set up a pension plan. I prefer to save through my corporation. Next slide. So how does the pension plan help? Well, when the medical corporation contributes to the plan, these passive dollars, these assets, actually leave the balance sheet. They're no longer considered assets of the medical corporation. They're now classified as pension assets held in the pension trust. So all of these PIG rules, all this TOPI stuff, won't apply anymore to any growth happening inside the pension plan. Therefore, it's not counted in that 1 to 5 grind, and it protects my $500,000 small business allowance much longer. So it keeps me at a 12.2% rate much longer than if I had kept that capital growing passively inside my corporation. Next slide. But that's not the end of the story. There's more, because there's another tax rule which we haven't talked about, I don't think, today, at least in detail, and it's the concept of the lifetime capital gains exemption. So business owners in Canada have this great tax advantage if they decide to sell the shares. As long as the sale qualifies, on the first rough, I think it's $971,000 of capital gains, they will be received tax-free by the shareholder. But in order to qualify for this special rule, there's certain conditions that have to be met. And one of them is that you can't have too much passive income on your balance sheet. So what accountants typically tell their clients to do is, and we'll hear from Moody soon, is the classic is, well, why don't you do an intercorporate dividend? Take the money out of the company whose shares you're trying to sell, move it to a new company. There's no tax on an intercorporate dividend. That way, you'll qualify yourself for this lifetime capital gains exemption. But unfortunately, that simply moves the passive income problem elsewhere. It doesn't negate the tax bill. Whereas if you're using the pension plan as a receptacle for those passive assets, you can strip them off the balance sheet, put them in the pension plan. So now you qualify for the lifetime capital gains exemption, assuming you qualify elsewhere. There are other stipulations that have to be met, but at least that part of it can be achieved. And you get a tax deduction in the process on top as a bonus. So the use of the pension plan is an aid to purification, which is this process of removing this bad passive stuff off the balance sheet. Next slide. Oh, here's another one. If in order to fund the pension plan, the medical corporation has to sell some of its capital property, like the stocks or the houses. We use real estate in another example. That's are invested in the medical corporation's non-registered corporate investment account, because we need cash to put into the pension plan, right? Well, two things happen. The first thing is that when the corporation sells this capital property, let's say shares or units of a mutual fund, only 50% of the gain is taxable. The other 50% is a credit to the company's capital dividends account. But 100% of the cash that's generated by the sale of that property that's contributed to the pension plan is a tax deduction. So when the corporate accountant files a tax return, there might be X dollars of capital gains to realize and pay tax on, but Y pension deductions to completely eliminate the tax bill from having liquidated that stock property. So now we've created capital dividends account credits, which we've been talking about today. Well, those are great because you can declare a dividend to yourself or to other shareholders in your family, and they pay no tax. This is a tax-free dividend. I mean, you can't get better than tax-free income. And the corporation paid no tax either when we liquidated that property to dump it into the pension plan. Next slide. So here's a numeric example. The MPC purchased 1,000 shares worth $100 each. For this from the retained earnings after it paid the 12.2% active business tax. Now they're worth 300, and the pension plan comes along and says, why don't you contribute $150,000? Maybe it's past service, current service, special payments, thermal funding, whatever. So there's a need for cash. So the corporation sells those 1,000 shares and realizes $300,000. Capital gain is the difference between the fair market value and the adjusted cost base. So it's really $200,000. But the taxable capital gain is only half of that because we have only a 50% inclusion rate. So the corporation is only facing tax on $100,000, but it's contributing $150,000 to the pension plan. So it ain't paying any taxes. In fact, there's an extra $50,000 of carried forward tax losses or carried back tax losses that you can, apply against previous years and get a refund from CRAs. It's free money. But more importantly, we've created a $150,000 capital dividends account credit. Sorry, $100,000. $100,000 credit. That's a typo there. So you can pull out $100,000 of tax-free dividends out of the corporation. Next slide. So again, I've deliberately kept my slides really short because it's been a long morning, and also I find a lot of learning comes from the exchange of questions and answers. But to summarize, we're not talking about death here. We're talking about while a physician is alive and using their corporation as a receptacle for money. We have to be careful about this new tax on passive income because it can double the tax rate on active business income, plus all the other problems, if we are not careful. And therefore, strategies that remove passive income off the balance sheet, like a pension plan or maybe insurance, if possible, those are all important strategies to carefully consider to, as Simon was saying, try to reduce the total tax bill. And as Nick said, tax being the largest destroyer of wealth, these mechanisms can really help with that. You're on mute.
Thank you very much, JP, for giving us this knowledge on TOPI and also the P.I.G. I have a comment about this. As a physician who've worked more than 20-something years in the profession, I find that one, the government is first allowing us to incorporate, but then tries to hit us on the head because we're using corporation to advantage, which they allow us to do, but now they're calling us tax cheats. And by doing all these, new laws to limit what we can do, we're definitely running into major tax issues, which we didn't have before. And the other comment I have is, knowing the burnout rate that we have currently in our profession in Canada and across the world, to be honest, many physicians are talking about either leaving the profession. Some of us have already left the profession, and you can look at the nurses, many have left the profession. Many of us are looking at, creating passive income, right? So that we don't have to work for income, so that there's a passive income stream. But by doing that, the government hits us on the head even more. And so it seems like there's no way out for us as physicians to try to manage our practice, continue to practice, but not in the ways that we used to do before and leveraging our corporation. So this topic that you're mentioning is extremely important, and extremely important because a lot of us have 10, 15 years under our belt, and we've been told to invest with the retained earnings in our corporation. So this is what we've done. So a lot of my colleagues are now going through this surplus stripping or capital stripping, and they're triggering a lot of capital gains tax, but they haven't done the pension, so they haven't neutralized these taxes. So all they're doing is just stripping away, but paying all these taxes when they didn't have to. And so this is very important for, I believe, physicians who are in mid-career and end of career, this topic that you just talked about. I have a question about, insurance, because you mentioned insurance a few times in relation to how to mitigate the PIG, the passive income grind. So maybe people are not seeing the relationship, how that happens. So can you maybe elaborate on that?
Well, I was explaining that one way to transfer passive assets that are generating passive income off the balance sheet where it's causing this problem was to contribute monies to the pension plan, because the pension plan is not part of the balance sheet. So therefore, any passive income generating in that context doesn't cause any PIG problems. The same thing happens when you're putting money in an insurance policy, a perma life insurance policy, and that there's growth happening inside the policy. There's no taxable passive income generating there either. So there are two ways to help the corporation deal with this passive income problem. There are other ways, but these are the two ones that I want to focus on. And so that's why. And one of the reasons is because growth, passive income growing inside of an insurance contract that's governed by the Income Tax Act, like these perma life insurance policies, whether it's a whole life policy, universal life. There's a section of the Income Tax Act called Section 148, and it specifies that the growth inside the policy of those assets is exempt from taxation. So it's not considered passive income to the corporation. And that's why, just like having it grow inside the pension plan causes no problem, having it inside the policy doesn't penalize you.
Okay, thank you. That was a good explanation, because it was hard for me to sort of see the relationship between what an insurance policy would do versus the problem. So, this PIG problem where you have that passive income grind and grinds down your small business allowance, and it doesn't take much, right? Anything above the 50,000, each dollar that is a passive income above the 50,000 claws back $5 of your small business allowance, so that $100,000 over your 50,000. So let's call it 150,000. So if you make 150,000 above, if you make 150,000 of passive income, you have totally destroyed the allowance of the 500,000 tax at 12%, 12.2%, which means at first OHIP dollar, or at first dollar from whatever, government gives you, you're taxed at 26.5%. I believe that's a 117% increase, or 100.
Yeah, it's a,
Yeah.
yeah.
So you've more than double your taxes on the active income that you're doing.
Yep.
So really, it's good to have passive income. It's good to invest, and it's good to make money off the market, but you're severely penalized.
But
Very penalized.
Dr. Trent, it's worse than just paying 117% more tax on the active business income. This passive income that you're earning inside the corporation, heaven forbid that it's interest income, because it's taxed at 50.17% corporately. So you have a 50% tax on the returns, that $150,000 of income, if it's interest income. And then you've got the active business taxation jumping from 12.2 to 26. You got to pay that tax on top. So if you add those two taxes together, I mean, why bother working?
Or why bother investing?
Or investing, right?
Right.
You're just giving it all away to the government, pretty much.
Right.
Because remember, once you've paid I'm going to use the extreme example of foreign dividends or interest income. You paid your 50% corporate tax. The company has paid an extra 12% or more than 12% of tax. And then you say, well, I want to spend that money. So you declare a dividend to yourself. You have to pay tax on the dividend as well. So there's tax again. I mean, it's completely crazy.
Well, I think what Canadian physicians don't realize, or one is we don't know what we don't know. So that I don't think we realize it, and we don't have the strongest financial literacy. I'll be the first to admit that. But two, we rely on our experts, so our so-called experts, so our accountants, right? And so we rely on them to give us proper recommendation. So how come this is not talked about? And how come myself and a lot of my colleagues don't hear about this PIG issue?
Well, I think it's starting to be more and more discussed, because if you're filing your taxes properly, you have to recognize this passive income, and you see that your tax bill is going up, right? If you've taken no measures to protect yourselves against that. So I think as people start to pay more and more tax, they'll start asking questions, and then there'll probably be more information forthcoming. But we'd like to be more proactive and prevent having to pay the tax if we can do so legally. And that's why the use of insurance, the use of pensions, all of these things together can really mitigate that tax bill. But we do need to make sure that the accountants that are also advising the client are familiar with these rules and the solutions to those problems. So I think that's really critical.
That's definitely. I mean, physicians don't have an accumulation problem. We accumulate enough money. What we have is a distribution problem, which is how much money of that do I get to keep? And as we've said it many times, tax is the destroyer of wealth, particularly for physicians and high income earners. So I'm going to stop the discussion for this topic here.